last week. One of our companies from our Canadian small cap growth stock research, a focus buy, was subject to a takeover bid, and I'm going to go over that quickly today. That company is H2O Innovation, symbol HEO on the TSX. Now trades at $4.17, $375 million market cap. What do? They're a water solutions company focused on providing best-in-class technologies and services to customers in three areas. That'll be water technology and services. That applies to membrane technology and engineering expertise to deliver equipment and services to municipal and industrial water waste and water reuse customers. Number two would be its specialty product segment. It's a set of businesses that manufacture and supply a complete line of specialty chemical, consumables, and engineered products for global water treatment industry. And number three would be O&M, or operations and maintenance, which provides contract operations and associated services for water and wastewater treatment systems. So last week, October 3rd, 2023, H2O announced that it had entered into a definitive agreement with Ember, an entity controlled by funds managed by Ember Infrastructure Management, essentially a New York-based private equity firm, at a price of $4.25. That represented a 68% premium to the prior closing price and a gain of 266% from our initial recommendation price of about $1.16. The valuation on that transaction, HEO trades with a trailing EV to EBITDA multiple of around 20, trailing price to CFO, or cash flow from operations, of 13, and a trailing price to adjusted earnings of about 48.1. Our take here quickly. Overall, and in consideration of the current multiples in the general and small cap markets, the offer appears to be relatively fair from a valuation perspective. We have just released our full update on HEO, or H2O, to clients with our full recommendation on what should be done with their shareholdings in the near and midterm, taking into consideration the 30-day go shop period, which is part of the deal. Ultimately, we see this deal or a potential subsequently higher offer as an excellent exit point from what has been a great investment in H2O over the past 4 years, with a return of 266%. It illustrates the type of strong returns that can be made by investing in high quality, growth oriented Canadian small cap companies. As a side note, our clients also received a list of 5 strong growth oriented small caps to redeploy their gains in over the next 1 to 3 months. So a solid gain here, and our clients are getting those 5 companies that we think can be the next HEO over the next 1 to 4 years to invest or reinvest that capital into. So it's a good outcome for sure. And we'll continue to watch to see if there's any subsequent bids for the company.
And the acquisition valuation, you were saying 20 times EBITDA?
Yeah, in that range. Yeah, 20 times trailing.
That's a good premium valuation, especially for a small cap company.
It's interesting, this company too. When I interviewed them 4 and 5 years ago, one of the takeaways from that interview, because you always talk about what are you looking to do 2 years out, 3 years out, 4 years out, and is there a potential exit point that the company would be looking at? What would that look like? What range would that look like? At the time, they said, well, we won't be taken completely seriously until we hit the $200+ million market cap or revenue run rate. Trailing 12 months, they're at 253. So, they crossed that 200 annual revenue range mark over the past year. And then it looks like, as they said, private equity got quite interested in the business at that point, and a takeover is the result. And it doesn't always line up perfectly like that. But in this case, in my notes from back when we originally recommended them, part of it was, at some point, a business like this could be a takeover target. And that's what we suggested in the initial report. I've talked about that all along the process, and the company received that bid. Again, given the overall market conditions, weaker for the small cap segment, this is a good solid exit point. And we've recommended for our clients what to do in that research report that we released today, or probably this podcast goes out a couple days later, so a couple days ago.
Yeah. And clients are up, what is it, 290% since our initial recommendation in
Yeah,
2019? I
260
believe.
to
Yeah.
290. I mean, the stock initially went down when we initially recommended it, so there was an opportunity to actually buy it, in the dollar range for some time then as well. So offered good solid value there. The company's grown every year, grown its revenues, which is what we like to see, and it's this is a good solution or a good exit point really for the business. There is that 30-day go shop period. We detailed that in our report and we gave our advice on what to do at that point. But to just give you an idea of where this company has come, in 2019 when we looked at it, or 2018, just under 100 million in revenue. So 99 went to 118, then 133, 144 the next year, 184. This past year, 253, and that's on the trailing basis, 253 million. So it's crossed that 200 million mark every year, growing that top line and providing good cash flow. So yeah, it was a matter of time, likely, before a transaction like this happened, and it kind of came to fruition the way that management originally had hoped it would, and which is excellent to see.